Okay, good. Good day to one and all. This is Dr. Sibraman of iknowindices.com. So every month during that of the second week Wednesday, I plan to give the tracking live the Forex market together webinar in two parts. Part 1 between 8 and 10:50 GMT and part 2 between 14 and 15 GMT. The basic idea of taking such a long time as much as possible is to show you in the live market how exactly the players plan before and make the specific type of moves. So we should be in a position to read them. So once we develop the ability to read the intentions of the player, then you find the trading becomes a child's play. So we need to really develop the skill set to read the live market code page. This is the live market code page. With the help of the simple live market code page, we will be in a position to find out what the players intend to do from time to time, whom they are trying to trap. And you have to follow the market using the GMT time frame. The GMT time frame is vital because the market is 24 hours. So when it is 24 hours, it is not appropriate to track it using your local time frame. Instead, you have to use the universal time frame, namely the GMT time. So this GMT time runs for 24 hours in a day. And wherever you come across the day, GMT time is running, you come across it is the day there. And thereby, you are able to find that the market is active for 24 hours. Even though it might be late night for you, but still it will be day in some other part of the world, and there the market will be active. So in order to understand that, you need to track the market using the GMT time frame. This GMT time frame is given in my website, iknowindices.com. There you come across the GMT time frame with that of the local time. So your local time will be picked up from your computer and the GMT time will be calibrated and that will be shown here. So you can easily understand what is your local time and also correspondingly what is the GMT time at the given time. Thereby you will be able to really understand that tracking the market using the GMT time frame will help you a lot to understand the various session starts, session close time, and also the gap time during that of the 24 hours market. Now this is the live market code page. I displayed it. The link for the same, I'll give it to you. You can use it to open this particular page in a separate window, and you can find out that the four majors Euro, USD, and GBP and CHF are being displayed here. That Euro is a numerator currency, GBP is a numerator currency because they are on the top of the ratio, on the higher side of the ratio. The lower side of the ratio you come across the US dollar, and here again US dollar. So it is a denominator. So wherever you come across the numerator is there, and then you find that that particular currency is supposed to be more popular than that of US dollar. And basically, they are the earliest currencies before the formation of US dollar. That is why they have been given the respect, like GBP, Australian dollar, and Euro, because the European currencies were joined together or combined and it has become a uniform currency now, and that is why it is also given the same status of numerator. The other currencies, namely yen and the CHF, they are in the denominator. Besides, you also come across Canadian dollar, which is in the denominator of the ratio. So these ratios are the conventional ratios. There are platforms, they also offer USD Euro ratio in CFD, etc. But this is the conventional ratio and this is being followed. What is the meaning of the word ratio? That means the strength of euro, strength of US dollar, and the relative strength is shown in fourth decimal place. That is how they are being calibrated. So the relative strength of Euro USD is 1.1144. That means what? If you give 1.1144 US dollar, you will get 1 euro. This is what when it is in the denominator. When it is in the denominator here, yen, so if you give 101.46 yen, then you will get back 1 US dollar. So that is how the currency conversion is. And these are all nothing but the ratios. And these ratios go up and down. So when the ratios go up and down, that means what? When the ratio goes up, euro, the numerator is strengthening. When the ratio comes down, the US dollar is strengthening. And that is why you come across the relative strength of those currencies. And when you try to understand, okay, when Euro USD goes up, that means Euro strength is going up. And you can also find it in terms of the fourth decimal level, which is referred as the pip. So the pip change is shown here as the net change. So the net change now currently shows 28 pips positive from that of yesterday US session close. Yesterday Tuesday US session closed 20:30 GMT. What was the prevailing euro rate? From there you come across it is gained about 29 pips now. It is slightly higher. Whereas on the other hand, USD yen from that of yesterday's close level, it has come down by 41 pips. So this way, red means it is negative from that of previous day close. Green means it is positive to that of the previous day close. Then you come across the high and the low and the current market levels. The high indicates from the start of the day starts by 0000 GMT. Okay, the day starts. Now 8 GMT. So slowly the market goes up, come down, goes up, come down. That is how it shows the fluctuations or the volatility. As a result, they set the high. And if they continue to breach the high and go above, new highs will be formed. They continue to breach the high further during the next session, the new high will be formed. Similarly, if the market goes down, the new lows will be formed. So currently, these are all the lows and the highs. So after about 2 hours, you will find the lows and the highs may be the same, or sometimes the low might be the same, high might be changed to the higher level. And high can go to the higher level, it cannot come down to the lower level, unless and otherwise it is the next day when they set the new high and the new low for this next day. So these are all the day's highs and the low now. But they set the initial low and the high around 3:30 GMT. And that if we note down and compare it with that of the current level, we'll be able to understand where they are taking the market. So this is the way simply we track the market in what way, whether on the upside or on the downside, the players intend to take the market. So we track it beforehand, because after the event, simply telling that euro is bullish or euro is bearish of no use, because we would not have taken any position. So without taking the positions, and afterwards when you have seen a visible correction or a visible rise and say that now euro has become bullish once it has come to 1.12, fine, we can give the comments about the market, but we are not entering into the market, because we have to foresee that euro has to go up, and then if we take a buy at the current level or slightly lower, so that when the market goes up, we'll be able to book profit. So ultimately, trading and the market comments are two different things. Trading requires the forecast, whereas the market comments is the current market the scenario, how the market looks like, and what are the possibilities we can discuss. If the market goes up, okay, this could be the support or resistance, and if it comes down, it's the support, and that sort of interpretation we can give, and they are predominantly of arithmetic importance. Because for the trading perspective, we need to know when exactly I can enter into the market and when exactly I can exit out of the market level. But instead of that, people talk about where you can enter and where you can exit in terms of levels. So when we can enter into the market is in terms of time, but where we can enter into the market is in terms of levels. So this you should be able to differentiate. All along, every technical analyst or the fundamental analyst is giving you the level to enter and level to exit. But if you ask them when that level is going to be shown in the market, they may not be able to pinpoint, or they may not be able to tell you the levels. So what is more important for us, because we are starting around 8 GMT, how soon I'll be able to finish my trade? No, because our lifestyle is based on the time frame. So if it is 8 GMT, probably it is the morning hours. Probably I can just wait for about 1 or 2 hours to finish the trade and go out for some other work. And will I be able to close my position during that time? In the event if I am not able to know the time, if I follow only the level and keep the level to exit for an entry position and go out, then all the time my mind might be worrying whether the market has hit my level or not. For that, what we do, we look in the mobile phone, the live market levels, and find out whether the market has gone there or not, whether it has gone there or not. In the event, if the market goes down in your mobile application, if you see that the market is going against your position, then you know that you have kept the stop. Then you will start worrying whether my stop is hit or not. So you find that trading becomes a very complicated issue if you do not know the time frame. But even though the traders complain about it, traders find practical difficulty pertaining to that, but still they find nobody is able to talk in terms of time frame in the market. So obviously the trader cannot expect the time to be informed, or the time to enter, time to exit. Those things they will not be able to get it from anybody for that matter. So in such a scenario, the trader has got no other option than to follow the technical analysis and say that, okay, this is the level to enter, this is the level to exit, or probably 5 or 10 pips away from that, depending upon various statistical studies, and then determine and keep the levels as the entry and exit. You can place the orders beforehand, no issue at all. But the thing is, how far the position is going to be successfully closed with profit. And the uncertainty will be lingering in the mind. So you are glued to the trading platform, and you are not in a position to go out or attend to other work. So once you become a very serious trader, you find the coffee has to be served on your table, the lunch has to be served, or probably the dinner has to be served, and everything has to be served because you are glued to the trading platform, because you do not know when the market is going to suddenly rise or drop. So with uncertainty, even when the market drops about 10-15 pips, and when your time is being tested, when your patience is being tested, then invariably you develop more fear. You imagine that euro could go down below that of parity, or euro could go above that of 1.14. You imagine all those levels, and then it triggers your fear. And if it is in your favor, then you become elated you feel that, okay, I'll be able to capture a very big profit when euro is going upward. But on the other side, if it start dropping, then you think that it might drop in a big way, and you are not able to determine up to what level it is able to drop. You try to find the support 1, support 2, support 3, etc. And invariably, you do not have a very clear picture whether euro drop will be supported at the first level or second level or the third level. The difference is about 150 to 200 pips. Will I be able to hold the position till such time? Because my equity may not permit. So you require the equity management as well. Besides trading, you have to think about the equity management. So this is what my equity is, about $3,000 or $5,000, and with which I should be able to trade and earn. So when you have so much of task, and what are the tools you have? Nothing other than the technicals and the fundamental analysis to determine the market from time to time. So invariably, if you go into that of the in-depth study of the market, then you find that the market continues to give you the surprise, because once you go in for the in-depth study, then you find there are various other methods of statistical studies which give different levels for understanding as supports and the resistance. Then you get really confused. So instead of making a very clear mind and developing a certainty with regard to the trade, you become more and more uncertain. Once the uncertainty is there, if suddenly the market goes up or come down, then you do not want to take risk. Then simply you close the position and get rid of the tension, because the tension, you find, it should be addressed rather than booking about 20-30 pips loss. So before that of any prime data release, you find when the position is not making profit, you do not want to hold the position until the data release, because you become afraid, and suddenly the loss becomes bigger. You may not be able to bear that loss. So you are not in a position to bear the tension. So you simply close the position before that of the data release. This is what happens to many of the traders when the equity is small. So we have to address to this particular issue also. For that, what method we can do it? Okay, you have a derived forecast. I have a method by which I derive the market forecast, but it need not be the same method you need to follow. You can follow any method of your choice and then derive, okay, this is the support and this is the resistance level. Okay, euro could be supported around 1.1113, the resistance could be 1.1176. Okay, fine. I can take a buy closer to low and exit when euro goes up. You can take a decision like that and keep a exit order at 1.1177 and find whether it is able to hit or not. You can do that. But when the market is holding silently for a prolonged period like this, you like to know whether euro will be able to really go up or not. Why suddenly euro has just become subdued, whereas GBP is making a small swing and testing the patience. So what do I do? How long I have to hold the position? Then this uncertainty you can get rid of by doing the market reading. So I'll explain to you how exactly the market reading has to be done in steps, so that you'll be able to really, irrespective of the forecast, whatever you're following, you can do the market reading and find out the intentions of the players from time to time. Then accordingly, you can take the decision. And also in the market reading, you follow the 24 hours time frame of the day, so that besides the level, you are able to focus on the time also. The time to enter, the time to exit also being predetermined or well defined, so that you are able to find whether the position is closed by that of the late session If it is not closed, then you close it at the market because you know that the next session the forecast says that the market might come down, or your analysis says that the market is in overbought condition, so probably the market might come down. So you do not want to take a risk or whatever the derivation might be. But once the time is lapsed, you can simply close the position without taking further chance. For that, you need the market reading technique. The third is the trading strategy, because in trading, you have to determine with regard to the entry, determine with regard to the exit, fine. But also you have to determine where exactly you have to place the stop. Because if the market goes against, where do I limit my risk? Whether it is an affordable risk, or whether I'll be able to withstand if I lose that much of money from my equity. Then you determine the stop and click it. And if 2 or 3 times when the stops are hit in your decision making, then you lose sizable equity in when the stops are being filled in 2, 3 successive trades. Then immediately think that, oh, I have to keep a wider stop. Then you go in for a wider stop. In the event if such wider stops are also filled, then you find, no, I should trade without stop. Then once you trade without stop, when the market goes against you, because you do not decide the behavior of the currencies. So you find that 2, 3 trades you are doing it in euro and find that, okay, it is making some deeper moves, so it is not advisable to trade without a stop. Then you go to some other currency and try the same method. All currencies are not traded in a similar pattern because the volume varies in different currency. Euro has got the maximum volume in the market. Then afterwards you come across the volume in the case of GBP. Then relatively lesser volume in the case of yen, and still lesser volume in the case of CHF. And Canadian dollar and Australian dollar volumes are much lower because they are active during that of the respective daytime in the respective country like Australia and Canada. So you find that Euro and GBP in a 24 hours market have got relatively a bigger volume when compared to the rest of the currencies. So the players find that both the sellers as well as buyers in these two currencies. So they will make upward and the downward moves in these currencies. But in the case of yen and CHF, they find relatively a lesser volume. So they will not make up and down move just like that. They may just make a gain and hold for some time, and continue to gain, hold for some time. Then make a small dip and continue to gain. Probably they may make one-sided rise or one-sided drop. In these currencies wherein the volume is relatively less. So in such a situation, what you have studied as a behavior of euro or a behavior of these two currencies, euro and GBP, the same behavior cannot be seen in the case of USDN and USD-CHF. They are different. So in such a situation, your trading understanding should also be fine-tuned to that of the type of moves they are making in the market. So you have to find out what sort of moves their players are making in these currencies. Then if you take the appropriate trading decision, you'll be able to really make money. Then still lesser volume will be seen in the case of USD CAD and Australian dollar. So for example, in the case of Australian dollar, on a daily basis, you would have noticed that they will make a downward stop and then quickly reverse the market and make an upward stop it. Most of the days, they will make alternatively in a session the downward and the upward stoppers. But in certain days, you might come across one-sided drop or one-sided rise. So you should be able to understand when such moves are going to happen in those currencies. In the case of Australian dollar, you come across that one-sided move with slightly a different pattern. So if they want to rise, they rise about 35 pips, drop about 10, 15 pips. Rise about 40 pips, then drop about 20 pips. Rise about 55 pips, drop about 30 pips. This is how they just go up and come down, go up and come down. In the process, you find the higher highs, higher lows are being formed. You might find it is easy to follow that particular pattern. But suddenly what they will do, they will reverse the market and drop about 100, 150 pips and then continue to gain 100, 150 pips and continue to gain 30, 40 pips and drop 15 pips. Gain about 40 pips, drop about 15 pips. That sort of move they will do it. So when they are going to make an extended downward stop and then continue the rise, we need to understand. So you know that Australian dollar, which was around 77 earlier, then it came down to 40, 75 level, and again it has come to 77 level. Similarly, in the case of Canadian dollar, it was around 1.32. From there, it came down to 1.30. Then again, it went up to 1.3175, and now come to 1.3056. If you look into the chart, and you will find it is an ascending formation or a descending formation or whatever it is you may call it, and use various parameters to find out what sort of curve is being formed, etc. But ultimately, we need to understand the time frame they use to do such moves. If you understand the time frame, then it will be easy for you to take an appropriate trading decision. Because every currency you find that you can do both buy and sell as well as sell and buy trades. In every currency, you can simply do a sell near that of the high set for the day and buy near that of the low set for the day. Then you can do a buy and then later on book profit, a buy and sell trade. Or you can sell later on. If you miss this level, you can sell later on near the high. And when it drops, you can book up, you can buy back against the sell and make a sell and buy trade. In every currency, you come across the buy and the sell trade. And you know that when the market is coming down, 1.1156 might be a sell level. Afterwards, the market would have come down. It would have come to 1.1075. Then now it is going up to 1.1156, holding around 1.114647. Then it will appear like a buy level. So when the same level was appearing like a sell level about a couple of days back, now it appears like a buy level. So that is market. Because when you are seeing the lower level, you find the higher level is a buy level. When you are seeing the higher level and suddenly when the market has dropped, then you find that that level is a sell level, it might come down further. So this is how you find the uncertainty is being developed in the mind. Once I develop the uncertainty, then even a rope will look like a snake for me, because the emotion grips him. Once I am being influenced by that of the emotion, then what happens? Anything will look dangerous. Anything might look very risky. In such a situation, my patience will be tested. So I want a trade wherein I enter in a matter of 5 minutes, I will exit with 30-40 pips profit. That's all I want. I do not want to hold it for hours together to make some profit. So I become restless. When the uncertainty tests your patience, I become restless, or you become restless. Once you become restless, then you want to go in for a distress trade. You do not want to hold. You perceive that the market might suddenly come down. You take a sell. And afterwards, when it is not coming, you close the sell and take a buy and see whether it goes up. Then afterwards, it is not going up. Again, you close your buy and take a sell and see whether it is coming down. So you become distress. You become a scalper. and you think that, okay, well, even if I get about 2-3 pips profit, it is fine. Then let me just try to take a sell and see whether it comes down 2 pips so that I'll earn 2 pips. Okay, when it has come 2-3 times, immediately you think that, okay, let me go in for a bigger volume so that my profit will be more. So instead of taking one lot, I take 10 lots and aim for 5 pips and book 5 pips profit so that it becomes 50 pips. So I go in for an arithmetic valuation of the pips what I earned, but I failed to do the arithmetic calculation of the risk what I am taking. When I take 10 lots, then my usable margin can hold only about 2 lots. And when I take 10 lots, the usable margin will become very feeble. Where even if the market moves about 15 pips, I'll get the margin call. So we don't relate that particular type of trading decision to that of the usable margin available. So normally people say that you have to find the how much of positions you can take, 1:100 or 1:50 and things like that. And you can take a decision accordingly, but lesser risk is always better and try to maximize the profit. So that if you take one mini lot or one lot or half a mini lot and things like that, half a standard lot, then invariably see that you book profit in that particular position before going to that of the next trade, because you always tend to develop that feel that it is a great opportunity to enter now. Afterwards, the market may not come down. But as soon as you take about 5 lots, then later on you find the market start coming down. Then immediately you repent and say, okay, I could have waited to enter into the market. And some people, what they do is, they take one lot at a given time. Then when it drops to about 20-30 pips, they immediately take another one lot or another half a lot. Then another 30 pips, another half a lot. Probably it is spreading the risk. But if they drop about 100 pips, you have already taken 3-4 lots. And if they continue to drop another day, then the risk multiplies because the market goes against all positions. So if you want to do the averaging, you need to understand that you cannot simply do the averaging every 30-40 pips. You have to do the averaging 150 pips away from each entry, so that even if you take about 3-4 lots, you will not get the margin call. So first of all, understand what sort of trading strategy you can apply, because trading strategy is an ocean in the market. If you plan well and understand in depth, you'll be able to find the trading strategy alone will give you the risk management. No other thing will give you the risk management. Simply keeping a stop is not risk management. It is a question of how you convert a loss-making position to a profit-making position. There comes your skill set. Because we know that in the market, many of the positions once you enter might give you loss. And if you simply take a decision, okay, about 5 to 10% of my trades I am willing to accept loss. That means you're not able to think beyond. Then you say, okay, I'll accept loss in 5 to 10% of the trades. The rest of the trades I'll earn so that I'll have some 50 to 60% of profit each time. But that might be your scenario. But if you just lose in 2-3 trades successively, then you become demoralized. You are not in a position to understand what sort of trading strategy you have to do it. Then immediately you think of waiting for the market to show the direction or the trend and then enter into the market. Then you become cautious. In the process, then once you become more experienced trader, you become more cautious because of the experiences of loss making trades. Then you say that let the market settle down, then later on I'll enter into the other market. So in the process, what happens? You wait for the market to settle down, wait for the market to settle down. And afterwards, once you take the position, the market is not making either upward or the downward move. It tests your patience. So You find great volatile moves happen during the data release time, but afterwards the market is highly subdued. And in that subdued market, what sort of trade I can do if I watch that I started the webinar around 8 GMT, about 45 minutes. The market is simply staying in the same levels. When it tests your patience for 45 minutes, then immediately you develop the aversion towards the market, or you think that there is no point in taking position in this current market, and then you just desert the market and go away and do some other work. And suddenly you come across a spike happening in the market. Then you repent and say that I could have just stayed for another 15 minutes. The market was waiting for the data release to happen, and afterwards it has made an upward spike. I was not having a position. So many people talk about the data and also the upward or the downward move and based on the impact of the event. But what sort of trades one can envisage during that particular time? Because of the uncertainty whether the market will go up or come down. The data is positive, the market can go up. If it is negative, it can come down. Similarly, if the data is positive, still, if the interpretation out of that is negative, the market can come down. Okay, the data might be negative, and if the interpretation says that market has already discounted that particular event, so the risk is going to be the event of the day, then suddenly the market goes up. Then you find the data release can give either way impact on the market. A positive data can also give a negative impact, and a negative data can also give a positive impact in a particular currency. In such a situation, it is total uncertainty. So you want to physically witness whether the market goes up or come down, and then later on enter into the other market. So you expect that retracement to happen in the market and enter into the other market. So suppose your data is positive to euro, and then when euro just goes up and comes down, then you think that it is better to enter at that time so that it will continue to gain. But there are occasions wherein the players continue to make further downward move, giving a different interpretation. Then you will be stopped out, and later on they will give an upward push. So we have to read the intentions of the players, not simply follow whatever the method you develop. So for that, whatever the market reading you do, in support of it, you need to have a trading strategy to limit the risk and maximize the profit. So keep that in mind, that forecast is one component, and it can go or it can become right. But many of the people think that the forecast should be always right, only then you can make profit. Many of the occasions, the forecast may be right, but when pips or move in the market, would have just closed your position. You would not have reaped the profit out of the forecast. So keep in mind that a mere forecast alone is not going to make you a successful trader. And market reading can fine-tune any of the forecast, whatever the type of forecast you follow. The market reading can help you to a greater extent to decide on the entry and the exit. But you can also follow the time frame and enter. But in the event, if they mix up knee-jerk reactions, if there is a rumor, sudden rumor coming out in the market, because of that the market is making a whip some move, and later on the people say it is only a rumor and it is being discounted, by the time your position would have been closed. So in order to hold the position during such uncertain condition, unexpected event, you need the trading strategy. So if you follow all the three, you will find on a daily basis you will be making money from that other market. So let me explain to you a simple trading strategy. Looking into that of the live market code page. LMQ is live market code page. So track the market using the live market code page. So this is the live market code page. And in that, you come across the high and the low and net change for 4 majors and 2 commodity pairs. And note down the high and the low set by 3:30 GMT. When they set the low by 2:30 GMT, 3:30 GMT, they will set the high. And if they set the high by 2:30 GMT, by 3:30, they will set the low. If you watch carefully, you will be able to understand. They have it for their reference. Okay, the players are doing it. It is not my own imaginations. Okay, the players do it that way. Then they are referred as the initial high and the initial low. For your convenience, I have noted down the initial low and the high for today. So in the case of, on a daily basis, you can note down the initial low and the high around 3:30 GMT from that of the live market code page. I noted down that 1.1113 is the low in the case of euro. Still, it is the same low. The high was 1.1156. It is still the same. So even though euro is swinging around that of the high, pretend as if it is going to breach and go higher, but it is not breaching it from 3:30 onwards. Okay, now in the case of GBP, 1.2995 is the low and 1.3091 is the high. It has not breached the low or the high. It is swinging in the middle level. Now in the case of yen, 101.17 was the high, low, but they breached the low and came down to 101.12 and come above that of 101.17. What it implies. So it has made a brief downward stop and come above that of the initial low, staying above in order to breach the initial high. So they make a breaching of the initial low and come above as a downward stop in order to make a rise. So which gives the explanation to us that we should buy USD yen. And also a currency wherein the spread is more than 40 pips. If you enter into the currency, you will be able to book profit quickly. Whereas in a currency wherein the spread is less than 40 pips, here it is around that of 40 pips. But if it is less than 40 pips, like USD CHF, then you will be holding the position for a prolonged period. But looking into that of the profit, it will be really testing your patience. So in such a currency, don't enter. So the selection of currency, you have to find the spread between the high and the low should be more than 40 pips. Then you decide on the major currencies. I'm not talking about crosses, only these 6 pairs I'm talking about. Crosses have got a different type of behavior, different study is needed for that. Then in the case of CHF, 97.93 is the low. They have breached 97.93, came down to 97.84 and holding below 97.89, below that of the initial low. So they breached the low during start of the European session and then they are holding it below in order to make a downward move in the case of USD CHF. And the high is 98.19, which has not been breached. So you find that in the case of denominator currency yen, they have breached the low and they have just come out. And in the case of CHF, they breach the low and stay below that of the initial low. Two different behavior. It has come above that of the initial low. Here it is, after breaching the initial low, it is staying below that of the initial low for more than 30 minutes of our observation. That means in the case of CHF, they wanted to make a downward move, even though it is a denominator currency. In the case of yen, they wanted to make an upward move. So you will not be simply looking into that of the US dollar weakening or US dollar gaining move. You will find out what the player intend to do. Then accordingly you find, okay, this is what the type of move is going to be. Then what you can do? You can do a sell and buy trade in the case of CHF. And you can do a buy and sell trade in the case of USD yen. How contrarian it is. But the players have done the contrarian move. Accordingly, you wanted to take positions. Then in the case of Canadian dollar, 1.3052 is the low which has not been breached. 1.3125 is the high which has not been breached. So you find that Canadian dollar is very similar to that of Euro and GBP. They are holding it within the range, but it is closer to that of the low. And in the case of Australian dollar, 76.62 is the low which is not breached, and 77.07 is the high. They breached the high and they are staying above that of 77.07. It shows that Australian dollar, they wanted to take it to the higher levels. It is staying above that of the initial high for more than 30 minutes. So what are the currencies which are going to be active? USDN, USD and Australian dollar are going to be active. The other currencies are going to be range bound because they are handling the respective crosses. So now looking into the of the net changes, you find that Euro, GBP, Australian dollar are showing positive net change. USDN, USD and USD CAD are showing negative net change. It clearly implies that they are making the US dollar weakening move. Euro by showing positive net change, GBP by showing positive net change, Australian dollar by showing positive net change. They are becoming stronger than US dollar. That means US dollar is weakened against these majors. And in the case of USD yen, it is negative net change. That means yen has become stronger, CHF has become stronger, Canadian dollar has become stronger because they are the denominator currencies. So when the denominator currencies come down, that means they are stronger. When the numerator currencies go up, they are stronger. So clearly in all currencies, they are making the US dollar weakening move. But are they going to continue this? No. They wanted to make a downward move in the case of USD CAD, but they wanted to make an upward move in the case of USD yen as a contrarian move. So even though it appears that it is US dollar weakening move in all pairs, they wanted to reverse the market. Now we have to look into that of the time frame. Okay, these are all the time frames of the various sessions. So you find that the Japanese session starts by 0030 GMT up to 7 GMT, and which is further divided into early 1.5 hours, late 1.5 hours. The balance is mid-session. Then 7 to 7:30 is the gap time. Then the European session starts. Now we are in the European session. So 7:30 up to 9 GMT is the early session. It is going to be the end of the early session, 9 GMT. Afterwards, the mid-session starts. 9 to 11:30 GMT is the mid-session. So they will be handling the crosses during that of the mid-session. Then 11:30 to 13 GMT is the late session. At that time, they will continue to handle the majors. So from 11:30 to 13 GMT, we'll come across the same US dollar weakening move. But from 9 GMT, suddenly you'll come across, they will make some mixed moves. If you look into that of the net change, you'll be able to understand from 9 GMT up to that of 11:30 GMT, they will make some currencies US dollar weakening, some other currencies US dollar strengthening moves. So that way they will handle the crosses. Then during the late session, they handle the majors. So first of all, understand how the players do it. So they make the spread between the high and the low more than 40 pips. Then they start handling those currencies actively. If the spread is less than 40 pips, they simply hover around and consolidate, but it may not give a big trading opportunity. Then afterwards, they handle only 2 pairs. I've given all those things here. You can make a note. Otherwise, these webinars are being recorded. You can just note down later on. 2 pairs at a given time and handle it. And why they take 2 pairs at a given time? Suppose they take Euro and Yen. two pairs at a time and make some quick moves in them. What happens? They can rise euro and rise USD yen as a contrarian move. As a result, euro will go up as a US dollar weakening move. USD yen will go up as the US dollar gaining move, and euro GBP will go up as a contrarian move. So by handling euro and GBP, they are able to handle euro yen also. Besides, by holding GBP, when euro goes up, then euro GBP cross also goes up. Then euro Australian dollar, when they hold Australian dollar, euro goes up. Then euro Australian dollar goes up. So they handle only two currencies at a given time. By that, they are able to bring in the volatility in the numerator as well as the denominator currencies of those two pairs. So that way, they are able to handle the specific currencies. So if the spread becomes more than 40 pips, you can just watch another 2 hours or 3 hours what currencies, what crosses they are being active, and find out that whether it was indicated by that of the respective majors. So the majors showing more than 40 pips, they are active, and the majors which are showing less than 40 pips spread between the high and the low are subdued, and they will be consolidating. And you will be able to understand that whatever the currencies they choose and make big moves, invariably the respective crosses will also show big moves. So in such a situation, if you are able to identify the big currency which is going to make a big move beforehand, you'll be able to really capture good profit out of such trades. So the selection of the currency, selection of the time, then selection of the level will tell upon the quantum of profit you are going to make from the other market. Hope you are able to understand that. It is not simply I am into the Forex market, I am 12 years I am in the market, or I have been consistently trading for about 18 hours in a day. They are all just attributes, but does not talk about the quantum of profit what you have made out of that market. If the quantum of profit is to be estimated, then you should have the ability to select the right currency, ability to select the right time frame, ability to select the right level. So the time frame you have to choose with the help of the time frame what I accumulate here, market timings. So you have to understand, if you want to trade in majors, you have to find out when the majors are going to be active. During the early and the late sessions, during the early and the late sessions, during the early and the late sessions. So in a given day, in 3 sessions, you will be able to do easily 3 trades. If you enter at the right level during the early session, you will be able to exit positively during the late session. It is possible, provided you are able to judge whether you have to do a buy and sell trade or a sell and buy trade. Hope you are able to understand how I am just narrowing down the trading concept so that you are in a position to give importance to that of the timings as well. So you should not imagine that these are all the timings which are theoretical, but if you look into that of the live market code page following this time, you'll be able to really understand how suddenly they become very, very active, how they become subdued, why in the mid sessions they are making a volatile move, which is different from the early and the late sessions. Even though it's non-farm payroll release or any other data, you expect the follow-up move to be in the same direction, but it is not happening because they suddenly reverse the market just like that. So you need to understand why they make such moves in the market. So ultimately, the players earn money by creating market sentiment and act against that of the sentiment given to that of the market. So this is what normally you come across in the market. Now, why they should create the sentiment? Because as long as we are human, if we use our common sense, we'll be able to think intelligently. We know very well when you touch fire, it will hurt your fingers. You won't touch the fire. You will be very cautious and you will be probably using a tool to handle anything which you wanted to keep it over that of the hot flame. So you won't just like that take your hand and show it on the flame. Fine. When you are when you are using your common sense, either you learnt it out of experience by touching the fire that it will hurt your finger, or somebody has said, or parents have said from that of the childhood, you know that if you touch the fire, it will hurt your finger. So you use your common sense. When you come closer to fire, it gives a warmthness, and immediately you recollect what you have learnt and you become cautious. When you go closer to the live wire, electric wire, it will give the shock. You know very well. You will handle it carefully and you will not touch it just like that. Or probably you will use a tool, specific tool to touch the live wire, etc. A non-conductor you will use to touch the wire. Fine. But in the event of crisis, what happens? Even though you think that you have to apply the common sense, you fail to apply the common sense. In the event of crisis, or a sudden knee-jerk reaction, or suddenly an unexpected things happening to you, and suddenly you open your door, you find a lion standing there, you become highly scared. Then instead of taking the fire to that of the lion, you simply catch hold of a hot burning iron rod. Later on, you just feel that you have touched the fire or a hot rolling rod, the hot rod. So when there is a sudden knee-jerk reaction is given, a surprise is given, the fear is triggered. And during that fear, you fail to use your common sense. It's what happens to the traders. You fail to use your common sense or recollect your common sense or your past experience. When you fail to do that, invariably, it happens to be a distress condition, a distress trade. You just click the platform and you find that suddenly the position is closed. Then later on, you realize you have done the double click because out of fear, your fingers start shivering. And then you find that you are making a lot of mistakes in that. If you ask any of the people who have been arrested for the crime, you ask them on what condition the crime was done, they will say, when I was under the emotional stress. So when somebody is under the emotional stress, he is bound to create a crime, and his mind will say that it is a justification. Suppose somebody takes a gun and shoot against others just because that fellow has used some wrong words. Then he has shooted him, or he has just found that he has triggered the pistol. Later on, he realized that he should not have done that. Under emotion, it appears that that is the right way to punish him. But afterwards, he will realize that who is he to punish him? If he has used the wrong words or the unfluent or the unparliamentary words, he could have reacted with similar words, or he can just ignore it and come out of that context instead of using a gun and firing against him. What happens? Then it becomes more complicated. Even though he wanted to come out of the situation, now even if you wish, you will not be able to come out of that situation because it becomes a case. So he has to go to the police station, he has to go to the court, and he has to face all the ordeal. For what? Because he was provoked. So when a person is provoked, and if he reacts and later on repent, but he cannot erase what he has acted during the provoked condition. That is irreversible. Suppose you clicked the trade and double clicked the position and the position was closed and you cannot do anything else. The position is closed with a loss. You can only take fresh position to earn back, but nothing can be done with regard to the loss. So such a situation happens many of the occasions because when we are provoked. And I always say that market rewards patience and not the impulsive conditions. Because when they trigger your impulse, invariably the players wanted to grab your money. But if you are patient enough, you have developed the habit of being patient all the time, or you try to use your common sense all the time, irrespective of such fear creating momentum in the market, then you realize that you are able to really look into that of the volatility as great trading opportunity. There is no uncertainty at all. You're able to easily understand what the players are trying to do it. So let me give an example. Somebody is taking a pin, showing it in front of your eye. First time he is trying to show it and you become afraid. Then he takes the pin closer to your eye, but he does not prick your eye, and later on he takes it away. Then if he does it 4-5 times, then your fear comes down drastically. Then invariably what you do is you keep your fingers or you keep your hands ready to prevent him hurting your eyes. In the event suddenly if he changes his mind to hurt your eyes, then you will be keeping the fingers ready to hold him, but you don't become afraid of such things. So you find invariably when you use your common sense, you are in a position to understand. Let me give another example. Let's suppose you have borrowed money from somebody and that person is trying to collect back the money from you. He is showing the pistol against you and say that I'm going to kill you. Then if you simply say that, okay, you can kill, but you will not get your money, and that is not your objective. If you explain to him, then he will think that, okay, this man is not going to be afraid of the gun. So when you use your common sense, you can talk against, or you can just tell him that you are not afraid. By such expressions, you convey that you are not afraid. Once you are not afraid, you are able to use your common sense and catch hold of his hand and turn the pistol or remove the pistol and throw it off and say that, okay, I'll give you after some time, that give me some time, but this is not the way to ask money. So when you are cool, you are able to come out with so many ideas. But when you are tensed, then invariably you find that you catch hold of his hand and try to pray to him that he will somehow pay the money and push his hand. By the time he would have pressed the trigger, and then automatically the bullet might have passed out of the gun. So that is not our objective at all. But when your hands are shivering, invariably it may lead to that such conditions. So always keep in mind that the emotional condition is not the solution at all in trading. So it is actually detrimental. When you become emotional, it acts against you. In such a situation, you have to find out what is the causal factor for such emotions. Because you are sitting alone at home or in your working place and you are looking to the computer wherein the online trading platform is opened and you find that nobody is around and you are listening to your music and you are calmly watching the market. In such a situation, where exactly the emotional trigger comes in? The players know your weakness because you continuously watch the live market quote page or the display of the quotes in your trading platform, or you see the live chart. It is a 1 minute chart or a 5 minute chart or a 15 minute chart or a 30 minutes chart. So you look into that. So you look for the candle formation, or you look for the sudden change in the numbers. If suddenly you find GBP showing 1.3100, 50 pips gain here, and a big green candle comes in, your emotion is triggered. So what is the causal factor for the trigger? A quick move in the market is the trigger. Suddenly, if GBP comes down to 1.3000, 50 pips down in a matter of second, at that too during that of the data release, then you find out what is the data, whether it is positive or negative, why GBP has come down. So you become restless. You wanted to get the information as quickly as possible. You keep all the places alert. Okay. That BOE interest rate decision, okay, this is the trigger, and this is what happened in the market, and that is why GBP has come down. So you assimilate everything. By the time GBP has already come down, what trade you have done? Nothing. But you are being given the trigger by a quick knee-jerk reaction in the market. How such knee-jerk reactions are happening in the market? Suppose you open your trading platform and just keep, when euro is at 1.3055, you keep a sell order, market sell order, 1.3000. You just click it, it will not go. Unless and otherwise, you simply place market. If you mention the level, it will not accept the order. So you have to invariably, if you want to keep a market order or keep a sell order below that of the market, the platform will not accept. Similarly, above that of the market, if you want to buy GBP up to 1.31 for another 50 pips straight or another 100 pips straight, it will not allow in our online trading platform. But in the bank, it is possible. They have a specific type of order and they place the order. As a result, suppose if they keep a sell order 1.3000, immediately market will be pushed down. That is why you come across a quick jump on the downside, a spike down condition or a spike up condition happen in the market. When a spike down or a spike up happens in the market, immediately you become stunned. What has happened to that market? Why such a move is happening? Who is giving the appropriate explanation for that? Nobody knows the explanation, but everybody will try to give an attribute to that. And in that process, they will simply say that, okay, be cautious, it has gone up. So it is, whether it's going to really go up, we have to see. Then later on, we'll enter into the market. That is how they will ask you to be patient, but you have missed the event. So all such quick moves are the trigger creating moves. The emotional triggers come from that of the quick moves. So you have to study the quick moves happening in the market so that you'll be able to easily understand their intentions. What are the quick moves they are doing it? A quick move which happens in less than 30 minutes is a stop and a false move. So stop and is what? They go above that of the initial high or low for about 15 to 25 pips. Just about 15 to 25 pips or 30 pips. And then reverse, quickly come below that and come down. So that is what happened in the case of USDN, I told you. The initial low, they came down, I show you, 101.17, 101.17 to 101.12, they quickly came down, and it's a matter of only 5 pips lower, and then come up and come above 101.17, staying above for more than 30 minutes. So that means what? A stop and below that of the initial low and come above that and stay for more than 30 minutes. So a move below that of the low, less than 30 minutes, is a stop and, which is a quick move. So that will give the trigger. for the traders. Why it is called as a stop hunt? Because it's my own terminology, but in market also prevalently it is being used. So below that of the low, when they hit the stops and come above, then it is stop hunt. They hunt for the stops which are placed below that of the support level, and then they hit and go up, then it is a stop hunt. The false move is the one they come from that of the high up to that of the low without breaching the low. They come above and straight go above that of the initial high and straight go up. That is referred as a false move. So a false move is a quick move. They will pretend as if they are going to drop it, come from that of the high to the low, and suddenly go up and breach the high and continue to rise upward. And that is what happens during that of the false move. The false move, they do it before that of the data release. That is why I was explaining that wait for such false move before that of the data release. And if they make an upwards move, quick move before the data release, then take a sell, you will come across the downward move. If they make a downward false move, take a buy, they will make an upward move after the data release, irrespective of knowing what is going to be the outcome of the data. So the players know beforehand what sort of move they are going to do it after that of the data release. See, if the data release is in line with that of their expectations, then they will say, okay, because the data is positive to GBP, GBP has gone up. In the event, if it is against the line of expectations, sometimes what they do is they just make a brief downward move and continue to rise. Or they simply continue to rise. If the traders are holding sell positions, they continue to rise and say that this particular aspect has been already incorporated into the levels, so that that level is discounted and that data is discounted, and then market continue to gain the level. So that is how they give that interpretation for it. So before the data release and during that the gap time, they make the false move. During the early and the late sessions, they make the stop hunt. Then these two moves happen in less than 30 minutes. Now the moves beyond 30 minutes and up to 2 hours, namely the extended move, which is again a quick move, similar to the stop hunt and a false move. So they make a drop below that of the low and stay below that of the low for more than 2 hours and then start reversing and rise it. That is extended move. It should be a quick move. So they quickly drop below that of the initial low and form the new low, but not breach the new low for 30 minutes and continue to hold below that of the initial low up to 2 hours and rise above that of the initial low and continue to rise is an extended move. The extended move is just to create the market sentiment. They create the market sentiment that GBP or Euro is weaker, and then they continue to gain the level. See, now during the top, they simply gained the level in the case of Euro. So more than that of the trade, I thought that I should spend this time to explain to you how to read the intentions of the players. Because many of the time, I find these traders struggle. So hope you will understand that when I spend more time in explaining all those things, you will really appreciate, so that what is learned will remain in your mind and that will eliminate the fear against that of the market players. So extended move is the one which is again a quick move, and they just come below that of the initial low, stay there for 2 hours and then start gaining. Then in the case of intentional move, from the word itself we can understand, it shows the true intentions of the player. That is, they just continue to gain every 30 minutes, breach the new high, every 30 minutes, breach the new high and go above. That is an intentional move. So here in the case of Euro, Then after that of 9 GMT, they started gaining the level. Then if they breach the new low, new high every 30 minutes, it is an intentional move. But if they stop cutting the new high and not going above that of the new high up to 2 hours, then it is an extended move on the upside in order to make the slide. So you can easily identify the extended move from that of the intentional move. During the intentional move, the moves will be slow and they will make a knee-jerk reaction. First of all, quick rise. Then afterwards, they will hold and gain and breach the new high every 30 minutes. Then it is intentional rise and they will slowly gain the level. Intentional move is a slow move. That means every selling they are absorbing during the rise. So when they absorb during the rise, all the sellings automatically they are not going to drop. Then what happens? Once they gained about 100, 150 pips and hold for the end of the day, then automatically the traders come for short covering and buy back against their sellings. So that is what happens in the intentional move. The intentional move, they just continue to buy and rise the market. They know very well all the people who have been selling will come for short covering. So how do you identify whether we can do sell and buy at that time or a contra trade at that time or whether we have to do a buy? So the condition is you have to identify the type of move. If they breach the initial high, stay above the initial high for more than 30 minutes and then they continue to rise and form the new high and they continue to breach the new high every 30 minutes, then it is an intentional move. On dip, you can buy. And if it is an extended move, they simply gain the level, stop cutting the new high for 30 minutes up to 2 hours and come below that of the initial high after 2 hours, then the intentional move will be on the downside. So you should be able to differentiate whether it is an extended move or an intentional move. Then accordingly, if you take the positions, you will have 100% success in your trade. So intentional move is a slow move which happens for more than 2 hours up to 2 sessions on the start of the 3rd session. That means they will make one-sided move for 2 sessions, European as well as US sessions. Invariably, most of the time they will start it during that of the European session, then the volume builds up, and then they will continue till that of the US session. In such a situation, you can enter into the market and book profit even in large volume. You will be able to get definite profit out of such trades. So identify the intentional moves and do volume-based trades during that time. Not simply say that I am taking 1:3 ratio or 3 positions, first position at this level close, second position at this level close, third position this level close, and the stop is about 120 pips below. They hit the stop, all your imagination is ruled out. So don't take such imaginary situations based on hypothetical studies. You have to practically see what is the volume in the market, which currency they are going to make move in the market. And that currency, if you bet, you will be able to make quick money. Nothing more than that. Because we are entering into the market in order to make money, out of money without converting into effort. Because normally what you do is when you have money, you open a shop and you convert the money into effort. You convert the money into product and store it in the shop. And people come and buy it. You keep a markup over it and sell it. And that becomes your profit. It takes a longer time. So you convert the money into effort or the product. And again, the product is converted into money. You find a higher money is being earned. Then the difference between the initial money and the higher money is the profit. But if you want to use the money and earn money out of that without converting to product, then automatically it will be considered as speculation. And in that process, The person who is trading against you is also playing with the money, but he has got a bigger money to play with when you have a lesser money. So the only way he can earn money from you is being cunning. So they make such quick moves, stop and false move or extended move against you, and you develop the market sentiment and act against you by making an intentional move against. So after that of the non-farm payroll, you know that when Hero and Jim we started making sideways move and a little bit of downward move, everybody thought that there's going to be a downward move in the market. But now you find that Euro and GBP, they are gaining the levels. Australian dollar also, they are gaining the levels. So this is how they create the market sentiment and act against it of the traders. Then finally, the type of move, swings. Swing is nothing but a move which happens near that of the high. See, after forming the new high, they are holding near that of the high, make about 5-10 pips upward and the downward move, which will give that impression to you that the market is live, it is not dead. So that when it makes a small dip, it gives impression to you it's better to buy. Then when it goes further downward, one more pip, then you think that okay, let it come down a little more, then I'll enter. So, and when it gains 2 pips higher, then you think that I should not miss that, so immediately you go and buy. So when they make some small swings here, a consolidation near that of the high, which will induce the traders to commit positions. That is why they make the swings. So once the traders commit positions, then depending upon the traders' pending positions, the players act against. So if predominant of the traders have taken a buy position after this rise, as a breakout trade, thinking that Euro will easily breach above that 1.12, then they will come down to 1.1154 and induce them to liquidate the long position or stop out. Then later on they will go up. This is why you come across such volatile moves happening in the market. So every move in the market is with a purpose. And the players alone can make the move in the market on the upside or on the downside. Only with the help of the bank terminals they can make upward or the downward move. You call all the traders world over, ask them to continue to buy Euro at the market. Euro can continue to remain in the same place. By placing such orders in a market, they will not be able to push Euro to the higher level. Okay, only in the bank terminal they can push Euro to the higher level or drop Euro to the lower level. So with the help of the bank terminals or the deal rooms, the players make such quick moves in the market on the upside or on the downside to trigger the emotions of the traders. And you have to identify what move they are doing it in order to understand what is their intentions. When they make a stop and okay, in less than 30 minutes they wanted to reverse the market, fine. Then let me take a sell so that they will drop, I'll book profit. I'll trade along with them. They make a false move before the data. Okay, a drop before that of the data release. Okay, they want to rise after the data release. I'll take a buy. Then let them rise quickly, I'll book profit. Okay, you are able to get the sense what directional trade you have to do it. Then extended move. Okay, they are making a downward move. Okay, let us see how they are handling the new low and the initial low. They are holding between the new low and the initial low for more than 30 minutes. Wait for up to 2 hours. Then later on understand, okay, there's going to be an intentional move on the upside. Then take a buy. Then they will start gaining the level. If it is an intentional move on the downside, if they breach the new low every 30 minutes or 1 hour, then you take a sell, you'll be able to book profit on the downside move if it is an intentional move. So identifying whether it is a quick move or a slow move. Quick move or a slow move is the only condition required for the trader. How we will be able to identify whether it is a quick move or a slow move? Will you be able to identify with the help of a 1 minute chart or a tick chart or a 5 minutes chart or a 30 minutes chart? Whether it is a quick move or a slow move? You might come across a big candle which is in relation to that of the levels. But whether it is a quick move or a false move or a slow move, you can identify whether they continue to breach the new high or new low. We'll be able to identify only with the help of the live market code page. Now we can understand the importance of the live market code page. See, I stopped using the live market code page from that of 2000 because afterwards I find that I start using the live market code page and exclusively the live market code page without looking into that of any of the statistical studies, even though I served as a statistics professor, applied statistics professor for 28 years. I found that in the market, the statistics will not be able to explain the manipulations of the players. The market is not manipulated, fine. Statistics will really help us to identify which way the market is going to rise or drop, and accordingly you can take positions. But the players pretend as if the market is following technicals and suddenly reverse and say because of fundamentals it is reversed. Then you think that okay, market is going to follow fundamentals, and then you try to commit position, then suddenly they reverse and say that no, market is now following technicals. So if you don't know when the market is going to follow technicals and when it is going to follow the fundamentals, then the uncertainty continue to be there because you use all the tools in order to reduce the uncertainty. But in the process, what the objective of statistics is being defeated. And many of the analysts, technical analysts, they end up in now telling, in the event the data is positive, euro can go up to this level. In the event if the data is negative, euro can come down to this level. Fine. What trade decision you can make? Okay. Now the data is released, euro has come down, and you say that market is bearish. Okay, euro has come down to this level. Look into the technicals again. You will see, okay, when the next event is going to be positive, then euro can go up like this. If the event is negative, it can go down like this. So you will give both the possibilities and continue to retain the uncertainty. As a result, what happens? You are not in a position to take any appropriate trading decisions. So whether euro is going to go up or come down, you are not able to understand. Then you look for the next data to be released, and probably you might get some more clarity after that of the data released by next week. Then look for next month non-farm payroll. Look for next month interest rate decisions. So you continue to look for it. Is something like you just stand near the beach and you want the waves to settle down, then you wanted to go for a bath. So how it is possible? Because in a surfing beach, the waves continue to remain and you have to take bath in that. And there can be low tide and the high tide, but the waves will continue to be there. You cannot expect the wave to stop or cease. So first of all, you have to understand that if the waves settle, then you will not have the joy of taking bath in the sea. You will not have the real pleasure. When the waves are there, if you develop the skill set to bathe in the waves, go along with that of the waves and come back, learn swimming and swim during that of the wave time, you find the real joy in such things. So it is something like sitting in a car and you say, let the traffic get settled, then let there be no person on the road or no other vehicle on the road, let me drive after that. Probably you may hardly find any time during that there is absolutely zero traffic in the market. Instead, you learn the art of driving. Then you know how to maneuver irrespective of the traffic in the market. You know when to apply the gear, when to apply the brake, when to use the signal, when to use the accelerator, as well as when to use that of the clutch or whatever it is, when to change the gear. You learned it, then you find it is a child's play. Then next time when you have fully learned driving, somebody might be sitting next to you. You will be talking to him without even focusing on the steering wheel or the brake clutch or whatever it is. You would have reached the destination. So once you become habituated in reading the intentions of the players, you find trading becomes an art, and you find trading becomes a child's play. Now, we have to eliminate the risk, or the risk has to be minimized in while trading. Because you know that when we are trading in the market, suddenly the players make quick moves and we won't be knowing it until we see. But after the move, we'll be able to understand what sort of move they have done it in the market. But if you are stopped out during that move, then we don't have any position to read the market. And once you are stopped out, the money lost will invariably make you frustrated. Then later on, you find, okay, let me give a break for trading. Then come back after 30 minutes or 1 hour. Then look into that of the trade. Or let me have a coffee break and then come back. So that is how you will imagine. Then you go for that and come back. By the time the market would have moved in your favor. Then you feel that I missed the boat. Then immediately it gives the trigger for you to jump into the running bus, and later on find that the bus has reached the destination already. At that time you have jumped into the bus. So these sort of emotional decisions come in, and emotions are constantly triggered during trade. It is something like that we may have to frequently apply brake when you drive the vehicle in a crowded area. It doesn't mean that you cannot drive in that place. You have to be cautious and you have to apply brake. And just because you have to apply brake, if you continue to hold your leg on the brake and try to drive the car, then your mechanic will say that you do not know how to drive the vehicle. The brake shoes have worn out. So you should not keep the leg on the brake. At the same time, you should have the quickness to apply the brake to avoid accident. And that sort of mindset you have to develop. How it is possible. Instead of stop, use the hedging. That is possible. Thereby, you will be able to really apply the brake needed and also find out whether you have done it properly or not. So instead of stop, we use the hedging. What's the basic trading strategy? Watch the market during the early part of the session. Now, here you come across the session times. Now, European session starts by 7:30 GMT and wait for 30 minutes from the session start up to 8 GMT. Okay. Then afterwards, wait for 30 minutes from the start of the market and identify what move they have done it in the previous session or during the gap time. Whether a false move during the gap time or an extended move during the earlier session. If there is a false move during the gap time, that means the opposite move they will do it during the session. So when they have made a false move on the upside during start of the session, that means they will try to drop during the session. So you take a sell position, fine. You observe that first 30 minutes, 7:30 to 8 GMT, they are not breached the high. Then you take a sell position, understand that they are just only done a stop it. And you have to keep 30 pips above the stop. If you keep the stop, if they continue to rise, what will happen? The stop will be filled and you will lose the position. And later on, if they drop, you won't be having a position to book profit on the sell side. So you can keep the hedge order to limit the risk 30 pips above. Then take profit order, if you are taking a sell position, can be to start with about 30 pips or 45 pips on the lower side if it is a sell and buy trade. So normally in the case of Euro and GBP, if you keep about 30 to 45 pips exit order or a take profit order, it should get filled. Then if the market shows profit in your sell side, about 25 pips, you keep stop at entry and remove the hedge order. Then here the hedge is used instead of a stop. And it is not filled, so automatically you removed it. But you have kept stop at entry. Then once you keep stop at entry and 45 pips above or below the exit order, take profit order, and the markets started coming down, you make the stop at the entry as a trailing stop. So that when the market comes down in the platform, automatically the trailing stop, maintaining a distance of 15 pips from that of the market, will come down. Then you can move down the take profit order on the lower side. That way, can simply maximize the profit. So initially you wanted to earn 30 pips. When the going is good, you wanted to make it 45 pips. Still the going is good, you wanted to make it 75 pips. Then you find that they are making a real intentional move on the downside. Good. And up to 150 pips you can make straight away by looking into the net change. Then find out, okay, they are going to take a drop about 150 pips. Keep 150 pips below the exit order, you will find that order is filled. Once you have studied the type of move, they have done it as the intentional move on the downside. So you find that such moves happen in the market very distinctly and as in line with that of your understanding, provided you follow these rules carefully. Similarly, if they are done more than 75 pips net change as one move, then they don't reverse it on the same day. So what happens here now? Euro is done 65 pips net change. GBP has done 54 pips net change. And Yen is 58. USDCH 42. Whereas Canadian dollar has done 86 pips. So it is not going to reverse during the day. And Australian dollar has done 57, 56. So USD CAD, they wanted to really push it down. So when they are done more than 75 pips net change level, they don't reverse it on the same day. The next day they can reverse it, but not on the same day. That shows that they find predominant of the traders are long. As the market proceeds, they will continue to drop and induce them, cut the new low, cut the new low, cut the new low every 30 minutes to 1 hour, and then induce the traders to liquidate the long positions. So when you identify that the intentional move is happening, you can add more and more sell positions and keep stop at entry in each sell position and maximize the profit so that you don't take unlimited risk even though you take more positions. This is how you can improve on your trading strategy. Okay, now this crucial situation. If the position is hedged, what do? We are watching the market and keeping the hedge order. When the hedge is not filled, we are able to keep stop at entry and we are able to use the trailing stop and we are able to trail that take profit order as well as the stop in the profit making position. So we are able to make profit. But we cannot expect all the time the sweetness to happen in the market. Market can reverse also. Market can give you the patient testing time also. At that time, how we are going to handle the position. So we will simply say that I am unlucky and close the position, or you try to convert a loss making position to a net profit. There comes your skill set. How it is possible. When the position is hedged, as I give the example, euro I taken a sell position, afterwards it has just come down and suddenly it goes up and hit my sell. I just imaginary theory, okay, imaginary condition. I'm just explaining hypothetical condition. It is hedged and that hedge order is filled. Then what are the possibilities in the market? Market can continue to gain above after the hedging, or it can hedge and come down. There are two possibilities. One, it can go up, or another one, it can hedge and come down. Okay, what trading strategy I have for that? So once it is hedged, and if the hedging is making loss for 30 minutes, then I understand, okay, they hit my hedge during that of the stop point. So if they had done the upward stop point, what will be the intentional move? Downward. So I simply close the hedge, which is not making profit for 30 minutes, and just keep another hedge order. Then afterwards they continue to drop, and I'm able to book profit on the sell side. And here I would have lost about 1 or 2 pips by closing the hedge, but I make about 40-45 pips profit in the right directional move. So I'm able to determine by identifying the type of move whether the hedge is filled up during stop point or during extended move or during intentional move. Okay. The other possibility, when the hedging is filled and the hedging is making profit for more than 30 minutes. So that means either they are making an extended move up to 2 hours above that market, above that of my level. That is why the position is hedged and they are holding above that of the hedge, and the hedging is making profit. And it can be an intentional move afterwards, or it can just reverse and come down. In such a situation, how do I demarcate it? Whether it is an intentional move on the upside or it is an extended move and the market will reverse. When they form the new high, and the new high is not being breached for more than 30 minutes afterwards, that shows that the extended move is happening in the market and they are likely to reverse the market. In such a situation, I can book profit in the hedge and keep another hedge order above, and then they will start coming down. Then I'll be able to trail the hedge order on the downside and book profit on the sell side also. So when you use hedging, you are able to identify the type of move and do either way trades. Buy side as well as you book profit, sell side you book profit. Because there can be only 2 types of traders in the market. One, a trader who has done the buy and sell trade. Another trader who has done the sell and buy trade. If we happen to be both the trade, we happen to hold both the trades, then you will be getting the maximum profit from the other market, capturing every moment of the market. In the event, if the hedging is making profit for more than 30 minutes and beyond 2 hours, then it is an intentional move on the upside. Then what are my options? After 2 hours, if it continues to make profit, then I can simply close my sell position with 30-40 pips loss and capture about 100-150 pips on the buy side, so that I get 110 pips net profit. 150 minus 40, 110 pips net profit I'll make on the once I close the sell with a loss and maximize the profit on the buy side. So I just simply reverse the trade using the hedge. Or I know very well that today they are going to rise it. Tomorrow, because there is going to be an event for that, they will make a drop. Then I can simply wait up to that of the 150 pips net change level and book profit on the buy side and keep another hedge order. And then once the market comes down, I can trail the hedge order downward and close the sell position with a profit. Okay, if you want to be a smart trader, I can take another sell after the rise of 150 pips. Then both the sells I can close below the average, or I can close each of the sell positions with 100 to 150 pips profit. So profit is there everywhere in the market, provided you know how to trade and capture it. Now coming to that of the trading, what trade we can go in for, because it is almost close to 10 GMT. We are in the mid session. So let me choose a cross. Now euro is showing 61 pips positive net change. GBP is showing 56 pips positive net change. Both are in positive net change. So obviously euro GBP cross may not show a significant move. It is only 7 pips move. So euro GBP has done only about 7 pips move in that. Any contrarian move we have to identify, then enter into that cross. Then all the crosses are showing, all the majors are showing USD weakening move straight away. So obviously the crosses are not going to show much of the swings. So here you find that all the crosses are showing subdued moves with net change of 15, 20 pips, 25 pips, 19 pips, 23 pips. See? So there is no point in taking a cross. Then let us look into that of the major, which is showing the intentional move. See how we are trying to select, eliminate the currencies and trying to select irrespective of the time. So if the time is 10, okay, accordingly we'll try to take. And I thought that we'll be able to do some trades in the crosses, but the crosses are not giving great opportunity because the spread is less, the net change is also less, about 20, 15 pips and things like that. That means they are not mainly handling all the crosses. What are the crosses they are handling? Euro CAD cross they are handling, because CAD they are just showing the maximum drop of 82 pips, and euro they gained about 61 pips. Now euro CAD, look into that, which is also making only 10 pips net change level, because both are showing US dollar weakening move. And what they are trying to do is they are trying to take out the stops above that of 45.90 level, and then they wanted to make a drop. It is 11 pips negative net change. They just taken the stops above that of the level and wanted to make a downward move. During that of the European session, so 1.4570. Okay. I'll keep a sell limit. $10 pips above that of the market. So that it's just fine tuning the entry. It is 456870 they are holding it. I am just keeping it at 4580, and the take profit order on the drop. So I keep about 70 pips take profit order because they have already done the drop in the case of CAD about 80 pips. So further drop and further rise in the case of euro can bring in further downward move for about 70 to 80 pips. So I'll keep 1.4510 as the exit. Then the hedge order 50 pips above that of the market, 1.4630. Because in the case of crosses, the volatility will be high and the volume is less. So invariably they will try to make more upward and the downward whips or moves. So we cannot keep simply 30 pips edge order and that will fill the order very quickly. So instead I am keeping 50 pips edge order. Then another position, in the case of CHF, I told you it is below that of the initial low. Now let us see. The initial low in the case of CHF is 97.93. They are still holding below that 97. So they are likely to come down in the case of USD CHF. A sell position, 0.9780, 10 pips above that of the market level, so that if they make a small swing upward, they'll be able to fill it. And 97.93 is the initial low. They are still holding it below more than 2 hours. They are likely to drop it, and I will keep the exit order 0.9710, about 70 pips below, and the sell stop 0.98. It is a major, so 30 pips. 0.9810. Then I was telling you that USD yen, they are holding it above that of the initial. They made a brief downward stop and I'm holding it. I'll try to take a USD yen position. Buy position, just about 10 pips, sorry, 101.22 and take profit around 101.90. Close it a bit of the high. So I am just keeping a buy limit order 10 pips below that of the current market level, so that if they hit and fill it, I'll get the fine-tuned entry, and the hedge order will be 30 pips below that, so it will be 100.92. Okay, these are all the trades I just contemplate. And also in the case of Australian dollar, we can take a buy because it is holding above the initial high for more than 30 minutes to 2 hours. So they are likely to go up. So we will take the position also in the case of Australian dollar, buy position. And below that of the current market position. It will be a buy limit. .7708 and the take profit 0. I'll just keep 45 pips. Exit order 0.7753 and the sell stop will be 30 pips below that of the market. This again a limit order, it's not filled yet. So in all, I kept the limit orders. So if they fill it, we can watch and understand. If they fill it, fine. We'll be able to continue with the trade and try to see how far we are able to book profit and maximize the profit. So you can just make a note of it. Otherwise, I'll come back by footing GMT and show you the results. The same page, I will show you what happened to those trades, and then you will be able to understand. So taking the trading decision is vital. Simply entering into the euro trade all the time, simply entering into that of the cross, thinking that which will not be impacted by that of the US dollar data or the European data. So let me trade in the crosses. Many of the people take decisions of that nature, but they need to understand that the players make the moves in the majors in order to bring in the volatility in the crosses. So the crosses will also have the impact. Besides, in the case of crosses also, they are not going to make technical moves. And if there are plenty of traders who are taking the buy position in a specific cross, the players are not going to rise and give profit to them philanthropically. They will definitely act against them, induce them to liquidate the long positions. That is why you found that last time when Euro yen and GBP yen were continuously gaining, and it is something like the carry trade. Many people thought that they can simply do a buy and sell trade, a small dip, a buy Euro yen or GBP yen, they will continue to rise, book profit. That is how they have been doing it. And suddenly what they have done, they have dropped about 1,500 pips in them. So if you are caught on the wrong side, then you need to know how exactly you have to reverse the trade. So trading is an art. Understand that. And then you find you'll be able to really make money. And simply trying your own method without any scientific evidence or back testing, etc. And later on you say that you have done different type of trades, but invariably end up in loss. When I take a buy position, the market drops. When I take the sell position, the market rises. And simply say that I am unlucky is worse from that of a person who is under the grip of fear. As far as market is concerned, market rewards patience, not even intelligence. Market rewards patience. But the patience should be a calculated patience. Then you'll be able to really get the profit out of that. Instead of it, if you try to indirectly read the market on the conventional methods, invariably in a manipulated market, they are not going to work. And about 10-15 years back, not many sophisticated statistical analyses were used. And now you find that various types of tools are developed. And unfortunately, the trading platform providers are offering such trading tools, and also there are other websites offering it without even scientifically testing it. It is a very unfortunate situation. And I have studied many of the tools which are developed by the platform providers and the websites. Invariably, the tools are wrongly prepared because they are not gone with it of the statistical procedure. So as a result, you find that without cross-checking the tool, we simply use it and find, okay, this tool we can use, the other tool we can use, and things like that. We get confused with so many tools which are available in the market and so many conditions they are putting it. And actually, when you go in for that of the moving average, let me simply take one simple example. When you go in for a moving average, the moving average is statistically derived in order to find out what could be the holding pattern of the predominant traders. That is what the moving average is supposed to indicate. Suppose the market has moved for about 5 days, and in that process, those who have taken the position which are making profit, they would have closed the positions. Those who have taken the position and still they are not in a position to close them with the profit, they will be sitting on one side. And when you go in for an averaging, in that process, you find invariably it will lead to that of the overbought condition. Then you find the moving average comes down. Then automatically you find that the traders who are holding the higher level longs lose their patience and trying to liquidate. Okay, this is how statistically it is supposed to calculate and give the concept whether the market is in overbought or oversold condition. So whether it is ideal for us to go in for a buy and sell trade or do a counter trade, be the first one to sell. So that is what we need to find out. There you come across the divergence. That is why we apply the MACD and the parabolic curves, etc., where exactly the intraday trend reversal could come in. But the platform providers, they have developed the trading tools or that of the statistical calculations which are irrational, without any meaning. They are simply using various other parameters and trying to give the simple moving averages and the parabolic curves, etc. And there are other platforms, they are using the names which are not statistically recognized. And it is very unfortunate because you don't find any professional statistician who is vouching all such terminologies which are available online. It is very, very unfortunate condition. So we find the statistics professors do not come to the labor market. So invariably, they simply ignore such derivations. So we need to understand how the platform providers are developing it. And what they do is they give that concept to that of the developer. The developer might be an engineering graduate, may not have an adequate statistical background, and he will be asked to find out these are all the parameters and they are to be taken into consideration and applied to the formula and then give the result out of that. Then invariably he just does the coding accordingly and he tried to test it, and when they find that the chart is coming and things like that and a curve is formed, then immediately they think it is right. whether it is optimized, whether it is in relation to that of the volume variations, and those tests, they don't do it. So invariably, the dynamic market is not being well explained by such statistical analysis. It is a very unfortunate situation, but still the traders are asked to follow those things, and they say it is free. So when it is available free, automatically nobody question it, because there's no point in fighting it. If you want to use it, otherwise throw it. That's all. So a scientific approach, a scientific study has to be done with regard to all the tools. Probably NFA should take the matter, and all the tools provided by the platform providers should be studied and certified and backtested and certified. Only then that can be allowed to be used by the traders, and such a situation should come. Only then the traders will be able to really have lesser misguidance with such analysis. And every time they come out with it of the God theory and things like that, what are the pending positions of the traders? Well, the platform providers simply say that we have predominant of the traders who are holding long position. We have predominant of the traders holding short positions. And how can they display? How can they display such information, which is supposed to be a private information? And also, you find that whether there are so many traders in the platform providers to have so much of long and short built up. And you ask any of the platform providers, how many clients are there? How many accounts are there? They will not give you the direct answer to you. So in such a situation, how they are able to say that the predominant of the traders are short and long and things like that? So many things are to be regulated in Forex market. Unfortunately, it is not happening. And the traders come here in a distressed condition in order to somehow earn money from the other market, in order to improve the lifestyle. And when they lose the money in the process and find that they are not able to act against that of the players, then they lose money and go elsewhere. So invariably you find that the traders may come and go, but the market will remain forever. That is how the market is remaining. But I've been watching for the past 25 years and more, and find that gradually the volume has dwindled. The market volume has come down drastically, because when the players have got the method of cheating the traders and earning the money, the platforms have got the method of cheating the traders and earn their money. How long they can do it? How long the traders will get cheated and continue to ignore what is happening in the market? Whether I am telling or not, they themselves will understand the platform providers are cheating every trader and the players are cheating every trader. So invariably, there should be an end to that. It should not lead to a situation wherein the Midas touch has happened. They might earn all their money for their wealth, but which may not be convertible for that of the players. So you know that I used to say that even among the animals, they have got a method of not to make their prey extinct. Suppose the lion population is there and the deer population is there, and the lion will always see that the deer population is being maintained. When the deer population is depleted, when the deer come down, they will allow them to propagate. They will allow the deer to propagate and just give birth to new young ones. Until such time, the lion will starve. They will not feed, hunt. And once the population increases, then they chase. Why they are predators? They chase so that the weak animals will not be able to run fast. And such animals alone they will attack and eat. So in nature, you find the balancing of an ecosystem is possible, provided they understand the counterpart. The predator understands the prey. The lion understands about the lifestyle of the deer. But here, our manipulator and the market players, market makers, out of greed, they are not able to understand about the traders. The platform providers not able to understand about that of the traders. And they say that, okay, you open an account, we will give you bonus. You open an account with $10,000, we will give you matching bonus. So they come out with such ideas. And if a common man asks the question, okay, I am coming out with 10,000 and I wanted to earn money, why you should pay 10,000 to me? And that means you are not having a straightforward ideas. And you give a wrong signal. And if I'm not able to understand that you are trying to grab my money, then I lose my money. So many of the traders have informed me that they opened their account with such bonuses. And the platform providers, when that because of the amount is more than that of their investment, say suppose somebody has opened an account with $5,000 and another 5,000 is added to the account by the broker, who may be a market maker or whatever it is. And then when the trader is making the trades and has taken more position because the availability is more and he has gone for averaging of the trading, and suddenly the bonus is withdrawn by that of the market players and the brokers. They say that, no, you do not know how to trade with the bonus. That is why we are withdrawing the bonus. Once they withdraw the bonus, the usable margin will be $50 to $100. They do it in such a way so that you have to forcibly close the positions with big loss. So automatically you have to close the positions. Then we fight with that broker. Then he will say, okay, you deposit another 2,000, we will deposit another 2,000. It is a gambling then. They are trying to do it. So understand that players, whether they say that they are regulated or not regulated, indirectly or directly, they are trying to act against their traders. And it has to come to an end. Otherwise, you will come across more and more reduced volume happening in the market. If there are any questions, you can ask me the questions. I'm willing to answer to the questions. No question has come so far about the market or any other conditions. So now you find that slowly they have made the dip in the case of yen to 30. They make for the dip, I'll get a fill. So I will follow the trades and then convert it into positions or modify and take the positions. Then show you the results by 14 GMT when I come back for the next session. Show you the results and you can understand now how I take the trading decisions depending upon the time frame wherein I enter into the other market. So that way you have to follow the time, you have to follow the level, you have to follow the currency, which currency you have to choose. Then you find that you will be able to close the position within the session as a session-wise trade. So I don't find any question coming out. So there are three components involved. I'll just try to summarize the talk. There are three components involved, namely the derived forecast, market reading, and the trading strategy. So I give more importance to that of the trading strategy because by that I'll be able to earn maximum from that of the market. And the market reading is to eliminate the uncertainty. The forecast is to eliminate the uncertainty to a greater extent, whether the market will go up or come down. And the forecast, I give it this form. Every Monday, I give the forecast for the week. And today, 10th of August, the market is expected to make a swing and slide during the Japanese session, then swing and rise during that of the European and the US session. So this is a gross forecast. Then afterwards, we are done the market reading. With the help of the initial lows and the highs, we have identified what sort of moves the players are doing at the moment, and then accordingly we have taken the trading decisions. Then afterwards, we followed the timings and the levels to enter. That is, fine-tune the level by simply taking about 5-10 pips away from the market. But we take the appropriate trading decision, namely whether we want to do sell and buy trade or a buy and sell trade. In the case of Euro and GBP, they are not breached the initial low, the high, till 8:30 GMT. So I have not taken any position. So you will be able to understand that because they'll be holding it, and the other currencies they wanted to make move, and what type of moves they are doing it. The quick moves are namely stop and false move, extended move, and the intentional move and the swings are slow moves. So when they make such moves, you can trade, and the other moves you have to do the contra trade. Then in the event if the forecast or the market trading goes wrong, then we use the hedging to limit the risk. And if the position is hedged, we watch for 30 minutes. And if the position is making really loss, we close the hedge with 1 or 2 pips loss or with stop at entry, keep another hedge order to limit the risk, 30 pips away. And then once the market moves in our favor, we try to book profit in the position. And even if the hedging is making profit, then we keep stop at entry in the hedge and wait for the market to make the intentional move or the extended move. So if it is extended move on the upside for 2 hours, stop cutting the new high. Then we book profit on the sell, buy side and keep another hedge order. Then they will start making the slide. We book profit on the sell side as well. If it is an intentional move on the upside, when we are hedged, the hedging is continuously making profit for more than 2 hours. We keep stop at entry, wait for 150 pips net change level to make profit on the buy side. Then keep another hedge order to limit the risk. The next day, when they make an extended move on the downside, we book profit on the sell side as well. So that way, either way trades, we can do it. That is possible in the case of Euro and GBP. Other currencies, the behavior is different. We have to follow the behavior and take positions accordingly. These are all the limit orders I have placed. Still, they are not being filled. So once the positions are filled, or if I modify and take the position, I will give the explanation to you when I come back during the part 2 of the Tracking the Forex Market Together webinar and explain to you how exactly we can fine-tune our entry after doing all those things, still keep the hedge order to limit the risk and track the market. And we can easily find out how we can capture the profit in the market moves. Since there are no questions, I'll just wind up the webinar. So I take this opportunity to thank FX Trade for the facilities provided to present the webinar, and you people for your patient listening. Try to understand the trading strategies besides the forecast and besides talking about what happened to that of non-farm payroll and how exactly the market is going to behave after that, or after that how FOMC is going to be, etc. is fine, provided you also learn how to trade and earn money from the market, because you as a trader come to the market to do trades and earn money. In the process, don't become an analyst, which is of no use. That is cheating yourself. So I'll come back by 14 GMT, and then I'll explain to you the results and the outcome of the trades, and we will continue to track the market from 14 to 15 GMT and understand whether the players are making the moves in line with the expectations of the forecast or against. Thereby, we will be able to be prepared for either way moves of the market. So, thank you one and all. Wish you all happy trading. I'll come back by 14 GMT, and you also please come and we will track the market together.